the S&P 500 has a tail up here where sometimes it gets more yield. On average, the yield of high yield bonds is roughly equivalent to the S&P 500 with roughly equivalent amounts of risk. And that's the big point here. It's just not as risk-free as many people think, and it's just not a safe place to be, particularly when we think we're heading into a stock market decline. Hello, this is Mike Preston at New Harbor Financial Group. The reason we're here is to give you some data and insight and purpose into what you're doing with your financial lives, with your investments. We really view that as the reason for our being, and we're happy to do it, and thank you for tuning in. Don't forget to subscribe to our channel. We really appreciate the people that subscribe to our channel. Leave your comments. We do read each and every comment and reach out to us. Down below in the bio is a link where you can reach out to us. We're always happy to have a conversation with anybody, whether they're a client or just curious. We're here to help. That's our mission. That's our purpose. And stick around to the end of the video. We're going to reveal the most common and riskiest places that people keep their money. So let's talk about the riskiest places to keep your money. The most important factors to consider when you choose where to put your money is really three things: safety, liquidity, and investment risk. So overall, how safe is the place you're putting your money? In other words, how likely are you to receive it back? Secondly, liquidity. How fast can it be converted to cash and delivered to you so you can use it for something else? And lastly, investment risk. What is the risk that you might actually lose some of this investment due to stock market action, for example? So these are the three most important things to think about when choosing where to put your money. So let's talk about our list of the riskiest places. The first one on the list is uninsured deposits. A lot of people think that you simply put your money in the bank, it's absolutely guaranteed, you can get it back when you want it. That's not really altogether true. Banks are in the business of lending money. You deposit money with them, they lend it out to others. Oftentimes, they lend it out to others on a long-term time frame. Early last year, there was some bank failures, the largest of which was Silicon Valley Bank. And the real reason for that is because Silicon Valley Bank took those deposits and then invested those deposits long-term. And then what happened is that short-term interest rates went from 0 up to 4 or 5%, and depositors all of a sudden demanded some kind of return on their money. So they said, pay me on my deposits or give me my deposits. And when those banks didn't raise their interest rates, the depositors said, give me my money. And so they all started withdrawing their money. The problem is Silicon Valley Bank invested those monies long-term, and those long-term bonds went down. Those long-term mortgages went down in value. And so therefore, it's a pretty short trip to see how a bank could go belly up when they have mark-to-market losses on the long-term investments, and then everyone wants their money back at the same time. So uninsured deposits are a very risky place. Deposits in the United States are backed by the FDIC, the Federal Deposit Insurance Corporation, up to $250,000 per person per account. Take a look at this chart. This shows the total deposits in the United States is $19 trillion of total deposits. Of those, only around $10 trillion are insured by the FDIC. So this implies that there's $9 trillion above and beyond FDIC limits that's completely uninsured. This is pretty interesting because last year, Silicon Valley Bank essentially went belly up, but the Treasury, the Fed said, don't worry about it. We're going to guarantee everything no matter what, even if it's well over the FDIC limit. Well, just last week, the National Bank of Lindsay, Oklahoma went belly up. And this time, the Fed said deposits above the FDIC limit may not be guaranteed. They're going to backstop those deposits up to the FDIC limit. But above and beyond that, investors may be out of luck. And so this is a big risk. There's $9 trillion out there of uninsured deposits. Not only that, the FDIC itself is underfunded. This chart shows that there's $10 trillion of insured deposits, but the truth is the FDIC is woefully underfunded to even cover that amount of insured deposit. I've got no doubt that the Fed would print money, the Treasury would back them to make sure that the FDIC is whole. And so therefore, our advice to people is FDIC limits should be pretty much sacred. If you are in the bank, make sure you're underneath the FDIC limits, regardless of the fact that the FDIC is underfunded. I think those limits would be sacred, even if the government has to print the money. So I would not be rolling the dice if I were you. I'd make sure that your accounts are under the FDIC limits. The next thing that is pretty risky as well is junk bonds. A lot of people over the last 10 years have been starved for yield. The Federal Reserve's zero interest rate policy has caused people to do anything possible to get more yield, including going into stock market, going into riskier bonds. And junk bonds are amongst the riskiest of all bonds. And as I said before, people have been inclined to move out the yield curve to try to get some more yield, but it's really not worth it. Take a look at the average cumulative default rates over the last 20 years or so. All global corporate finance, which includes junk bonds, is around 4%. And junk bonds themselves is really anything below triple B. So you see in triple B, there's 4 and change percent default rates, but that rapidly goes up towards 40% when you get down to triple C. Therefore, I just don't think the spread or the pickup in yield is worth it. You're only getting about, on average, a little over 1% more for most of these junk bonds. Admittedly, it's much higher down here in the triple C range, but the default rate is just that high. And this is before a recession. This is before a stock market crash. This is a dot plot. It's a little hard to understand, but the green here is the high yield bond ETFs. And what this shows is standard deviation across the x-axis, and then yield since inception. This goes back to 2001. And what it shows here is the returns in the junk bonds, or the green, are in the range of plus 10 to minus 10%. The standard deviation isn't that much different than some of the other things. Like, for instance, take a look at the S&P 500. The S&P 500 has a tail up here where sometimes it gets more yield. On average, the yield of high yield bonds is roughly equivalent to the S&P 500 with roughly equivalent amounts of risk. And that's the big point here. It's just not as risk-free as many people think, and it's just not a safe place to be, particularly when we think we're heading into a stock market decline. You might run into a lot of people on YouTube that are saying that junk bonds are an easy way to get additional yield. Don't believe it. It may have been true in the past, because we've been bailed out of just about everything. But the truth is that going forward, you're going to want to be in the safest possible bonds. The junk bonds are riskier than you think, even though you haven't seen any large declines in them since 2008, 2009. But if you take a look at what junk bonds did, just for example, take a look at the ETF ticker symbol HYG. It's not a recommendation. It lost nearly 50% during the Great Housing Crisis. So bonds that lose near 50% are not low-risk investments, so don't believe everything that you hear. The next one on the list is cash value and life insurance products. A lot of people out there think, and a lot of influencers have said, well, use life insurance vehicles as a savings product. Well, the problem with doing that is not all people need life insurance, and life insurance always has a mortality and expense charge. That is an above and beyond the savings component, and so it's complicated. But some schemes out there basically say, save in life insurance products and then borrow against them tax-free later on. And in theory, that works. It's possible. But I want to talk about the safety of the cash component in that type of plan. If you have a cash value life insurance product with, let's say, hundreds of thousands of dollars in cash value, that indeed is an important asset in your financial plan, but it's not as risk-free as you might think. Cash value life insurance is subject to the credit worthiness of the insurance company. Now, most of these are very credit worthy. I'm not saying these are highly risky, but they are not FDIC insured. They're not backed by the government. So they're closer to what a high quality corporate bond might be. Therefore, I wouldn't call them risk-free investments. They are low risk, but I'd still be careful about parking too much money there. I think that we're entering a time in this market that's going to be very difficult. I think we're entering a climax of a fourth turning, for those of you that know what that cycle is. And therefore, you're going to want to be in the very safest things, and that doesn't include cash value life insurance, in my opinion. And now for the riskiest place on our list. And you may not be comfortable to hear this answer: stock market index funds. Many people, and in fact, I would say the majority of folks in this country, are parked in stock market index funds at valuation levels that we've never before seen. And they're feeling like it's risk-free because the Fed always guarantees things and continues to buy every dip, essentially, or at least encourages people to buy every dip. And this has been working since 2009, going on 15 years. So take a look at this chart. This is the estimated S&P 500 loss, the blue line, that would be needed to reach a valuation norm associated with a 10% average annual return. And this red piece, or the red graph here, is the actual deepest loss in the S&P 500 over the following 10-year period from levels that are observed from this blue line. So this blue line is essentially a permutation of a valuation metric that says, where do you have to go to get 10% returns? This goes back over the last 100 years. And if you look carefully, the red and the blue are pretty much aligned, or at least they're correlated. And now it ends 10 years ago because it's basically saying what's the deepest loss over the subsequent 10-year period. Long story short, this chart shows that we should close this gap between the red and the blue. We always have. But for the most part, this is a pretty good correlation. This shows, if you look, shows around a minus 70% loss that would be required right now to get back to a level on the S&P 500 that would give you 10% returns over the next decade. I can't guarantee that that's going to happen. Obviously, I can't. I don't know the future for sure. I can only say that the data says it should happen, and it always has happened in the past. This time has been different. I'll admit, this time has been different for longer than ever before. I don't think it will continue to be different forever. So this is the end of at least a 42-year bull market. It's a grand super cycle, if you will, in the stock market. And it's the end, I believe, of the financialization era, or at least of the easy money printing era. Nobody knows how this is going to end, but history says we're going to have a big drop, and I believe that history matters. There's a lot of people out there saying that certain banks are good and certain banks are bad. And the truth is, nobody really knows for sure. And there's no real database or filter that can help you say that this bank is good and this bank is bad. Don't believe the hype. Honestly, really, the best thing to do is choose a bank that you're comfortable with and keep your deposits below the FDIC limit. I know that's a leap of faith to say that FDIC is going to be sacred. A lot of people prefer small local banks. The big banks, you might argue they've got more capital and wherewithal to withstand a downturn, but they also have more exposure to derivatives. The things that you want to look at in a bank are fees. A lot of big banks have notoriously high fees. Most importantly, ATM fees. Many banks, particularly small banks, reimburse. Interest rates are important these days. A lot of banks are still paying really low interest rates. You should be able to today get at least 3.5%, maybe 4% or better. So take a look at that on both checking and savings. If any of your life savings or earnings are sitting in any of these risky places, reach out to us. The link is in the bio down below. If you're looking for a financial advisor or not, doesn't really matter. Or if you're one of our clients, we're happy to talk to just about anyone. Reach out to us. There's a link below. We're happy to chat. We offer a free consultation to anyone. So just click down below and reach out to us. Let's have a conversation. Lastly, in a couple weeks, keep an eye out. We're going to release a follow-up video of where's the safest places to put your money. So until next time, thank you for watching. This is Mike Preston at New Harbor Financial Group. See you soon.